మాట్లాడుతున్నారు లైవ్ చూద్దాం.
We have been recording, as you are aware, a high growth rate of about 17% in services exports in the last 4 years and about 14% compounded annual growth rate of remittance receipts in the last 4 years ending 2024-25. This has made up more than for the higher merchandise trade deficit that we had last year. The merchandise trade deficit further widened in Q1 of 25-26. India's share in world services exports has risen markedly from about 2% in 2005 to 4.3% in 2024, driven by strong software and business services exports. Robust services exports coupled with strong remittance receipts are expected to keep the CAD within sustainable level even during the current financial year. On the external financing side, gross FDI to India remained strong during April to May 2025-26 this year. However, net FDI moderated during this period due to higher outward FDI. FPI inflows to emerging markets and economies have remained strong in May and June 2025. However, net FPI to India recorded outflows of 0.8 billion US dollars this year so far till July 31. This is mostly on account of outflows in the debt segment. External commercial borrowings, on the other hand, witnessed higher net inflows compared to that last year. Inflows under non-resident deposits too remained positive, albeit witnessing some moderation. As on 1st August 2025, India's foreign exchange reserves stood at a robust $688.9 billion, sufficient to cover more than 11 months of our merchandise imports. Overall, India's external sector continues to remain resilient. We remain confident of meeting our external financial requirements comfortably. I will now turn to liquidity and financial market conditions. System liquidity as measured by the net position under the liquidity adjustment facility has been in surplus on an average of about 3 lakh crore rupees per day since the last MPC. This is in comparison to an average daily surplus of 1.6 lakh crore rupees during the previous 2 months. Going ahead, as the CRR cut announced in last policy comes into effect in a staggered manner beginning September, it would further support liquidity conditions. The comfortable liquidity in the banking system has reinforced transmission of the policy repo rate cuts to the money, bond and credit markets during the current easing cycle. In the credit market, the weighted average lending rate of scheduled commercial banks declined by 71 basis points as against the 100 basis points rate cuts for fresh rupee loans, and of this 55 basis points is due to interest rate reduction, the remaining on account of the change in the mix of the loans. Further, on outstanding rupee loans since February 2025 to June 2025, there has been a 39 basis points reduction in the weighted average lending rate. On the deposit side, similarly, the weighted average domestic term deposit rate on fresh deposits moderated by 87 basis points during the same period. Moreover, the transmission to lending rates has been broad-based across all sectors. Going ahead, the Reserve Bank will continue to be nimble and flexible in its liquidity management. We will endeavor to maintain a sufficient liquidity in the banking system so that the productive requirements of the economy are met and transmission to money markets and the credit markets remains smooth. Here I would like to take a moment and mention, while we are on this subject of liquidity, that an internal working group, as some of you may be aware, had been set up by the Reserve Bank to review our extant liquidity management framework, which has been in operation since February 2020. It had been 5 years. So this working group was set up. It has submitted its report, and we will be shortly publishing the same on our RBI website for public consultation. The group broadly has found that the WACR, the weighted average call rate, is highly correlated with the other money market rates, with TREPs and market repo in the collateralized segments. Further, they have also found that it is effective in transmitting signals to other money market instruments across maturities. Therefore, the group has recommended continuation of the overnight WACR as the operating target of monetary policy. The group has inter alia also recommended to continue with the variable repo and reverse repo rate auction mechanisms of various tenors, with the objective of maintaining the operating target rate at the policy rate. I will now come to financial stability. The system level financial parameters relating to capital adequacy, liquidity, asset quality, and profitability of the scheduled commercial banks continue to remain very healthy. The CRAR is more than 17%, NIM at 3.5%, the liquidity at 132%, the GNPA at about 2.2%, NNPA at about 0.5 to 0.6%. The credit deposit ratio for the banking system is at 78.9%, broadly similar to that a year ago. Similarly, the system level parameters of NBFCs too are sound, with adequate capital position and improved gross NPA ratios. Bank credit grew at 12.1% last year in 2024-25. And I want to highlight over here that while it was slower than the growth rate of 16.3% in 23-24, it is higher than the average growth rate of 10.3% recorded in the 10-year period preceding 24-25. Moreover, it is important to look at all sources of funding to the non-financial sector and not only bank credit. And so we find that in 24-25, while the bank credit, non-food bank credit in fact, reduced by about 3.4 lakh crore rupees from 21.4 lakh crore to almost 18 lakh crore, the flow from non-bank sources more than made up for this decrease. Thus, even though growth rate of bank credit slowed last year, the overall flow of financial resources to the economy increased from 33.9 lakh crore rupees in 23-24 to 34.8 lakh crore rupees last year. That is an increase of almost a lakh crore of rupees. And we find that this trend continues even during the current financial year. As transmission to money markets has been faster, large corporates increasingly have relied on market-based instruments such as commercial paper and corporate bonds to source funds, reducing their exclusive reliance on bank credit. Similarly, profitability of large corporates has increased. Their internal resources, therefore, have become an important source for business expansion. Before I conclude, let me underline that for us at RBI, the interest and welfare of citizens of India is foremost. It is the people of India, including those at the very bottom of the pyramid, who are our raison d'etre, the reason of our being. In this regard, therefore, I have 3 consumer-centric announcements to make. One